Here we go. So Miyata, he'll be moderating What's New and What's Now in the US. A round of applause, please. And 3 panelists. Saeju Jeong, co-founder and CEO of Noom. Trevor Kienzle, Managing Director at Correlation BC. And last but not least, Masami Takahashi, who is President, starting very soon, I hear, at Uber Japan. Yeah, please.
Okay. Yeah. So, what's new and what's now in the US? It's a broad, very big thing. But here we have the great guest from US, the BC and Uber, big startup, and the startup from Europe. So let me start introducing the panelists today from left to right. Trevor Kienzle, the founder and managing director of Correlation Ventures, a predictive analytics-oriented, venture capital in Palo Alto. He's a long-time VC, starting from 1997. He's like a senpai of my venture capital today here in the US. Next, we have Masami Takahashi, the president of Uber Japan. Basically the fast-growing, disruptive, company in the taxi and the logistics as well. Prior to Uber, he used to work for the Sony, so that he has the really interesting perspective from a big company and a startup and the US and Japan. And we also have Saeju Jeong, the founder and the CEO of Noom, which is the leading the whole provider for healthcare, which has the 20 million downloads so far. And he's now based in New York, but originally from Korea. So he also, has the both perspective of Asia and the US. Right. So today, basically, we have a great guest, from research to startup. To start, Trevor is really, the data-driven, venture capital guy. So he will share his, data and analysis of what is now and what is new in the US venture ecosystem.
Thank you, Todd. It's a great honor to be here in Japan at B Dash. Thank you for inviting me. So I'd like to do a couple things. First, give you a brief introduction into our venture firm, very brief, and then describe some trends in the US venture industry that have been derived from my venture firm's data set. And so my firm, Correlation Ventures, is investing out of a $166 million venture capital fund. We were founded by experienced entrepreneurs like Tak, entrepreneur before being VC, and by experienced VCs. So my co-founder David Coates and I met at the Harvard Business School. We've both been VCs now for about 17 years. Our team has a head of analytics who manages a 5-person predictive analytics team. His name is Anu Pathria, and he's world-renowned for having been co-inventor of a product called Falcon, which is the leading fraud detection product worldwide for the credit card industry, used in about 60% of world transactions daily. Grace Chu Miller was CFO at Bell Capital Management, which is very active in Asia, Japan, and China for 8 years. So we're building a portfolio of about 100 private companies, very diverse by industry sector, by investment stage, and by US geography. Our investors are leading institutions, university endowments primarily, but also foundations, pensions, large multifamily offices, and fund funds. We're unique in 2 ways. First, we are a co-investor. We can only consider opportunities that have another qualified venture capital firm making their first investment in a given company when we are. Talk, for instance, at Scrum Ventures. We're providing a unique value proposition in that oftentimes when the team has gone through 6 months of due diligence with a qualified lead like Tak, not to say that his process is that long, but some people's are, the last thing they want, once they choose their new lead, is to add more decision makers. So we provide all decisions in 2 weeks or less, and we make smart decisions using our analytics in that time frame. Our process is very painless. We ask for 5 documents in order to populate our 30-factor algorithm. We don't take board seats. We're very flexible on investment size, and we're very reliable in following investments. Secondly, we're the U.S. venture industry's predictive analytics pioneer. We've spent about 8 years building our data set, which we believe is the most complete of venture capital outcomes. We'll share some research from you in just a minute that was derived from that data set. And we also use our predictive analytics to make all decisions. So every investment must score highly in our analytics to be considered.
I mean, it's a pretty unique approach. I mean, the venture capital is basically you meet people and then you talk to them. No, but I'm really impressed with the internal approach based on data analytics. So today we see some very interesting data.
Thank you, Tak. And as Tak mentioned, the subjective analysis that a VC like Tak and Scrum do is absolutely critical. And every one of the investments that we do has undergone the rigor of a new VC like Tak. However, what we don't need is people to repeat his process many times in the same investment round. And we save the team the hassle of that. So we've had great reception from our peers. This shows you some of the venture funds that are our partners that we've invested alongside. You've got large funds like Excel and Kleiner Perkins, Sequoia, etc. But you also have small firms like a True Ventures or Union Square Ventures, or you'll notice a very special firm right here, located between Redpoint and Sequoia, Scrum Ventures. Good positioning. So let me turn now to what's more interesting, industry data that we have extracted from our data set. And the news is good. U.S. venture capital returns have improved dramatically since we unwound the bubble in the early 2000s. And with the exception of the 2008 recession, returns have increased fairly consistently over that time frame. So what you see here is the average return for all financings that exited in a given year, whether it was IPO, out of business, or acquisition, good, bad, and indifferent. And you also see in the dotted green line the 90th percentile. So the 90th percentile point in the distribution, arguably winners. And again, a dramatic improvement in returns. Now, let me focus on 3 drivers. What is causing this improvement, or what has caused this improvement? The first driver is the magnitude of the exit values. What price are companies exiting at? And again, this is US data only. Again, here I would focus on the 90th percentile number, the big winners that drive industry returns. And again, with the exception of the 2008 recession, dramatic improvement. So from 2004 to 2013, about a 2.5x improvement. And I should stress, these numbers are all real numbers. So we removed inflation from the equation. These are not nominal, these are real dollars.
Yeah, one thing I can add is that in Japan and Asia, let's say like 10 million exit, like 20 million exit, it's like great. Like a big company buy a small startup with a 10 to 20. But what's happening in US, like much bigger, 200 million, like 300 million, right? So hopefully Asia could be like this.
Yes, I hope so, and we want to support the building of the ecosystem here. So, as Tak is pointing out, 1 out of 10 deals in the US in 2013 generated a $250 million exit rate. Second key driver, the valuations that investors paid going into the companies, the pre-money values, again in real dollars. Here I would focus not on the outliers, right? The green line shows the outliers, and they're always going to be very expensive deals. So we hear high-profile rounds that are very, very high, and oftentimes justified, as we'll hear from my colleague from Uber, in terms of their progress. But focus on the blue, right? So median pre-money valuations are about constant. So it shows tremendous discipline over the last decade. And then third key driver, the cumulative dollars raised through exit, a measure of capital efficiency. And again, here I suggest focusing in on the blue line. So this is an incredible story that in 2004, the average round was, or the average company took about $17.5 million to get to an outcome. And then last year, about 9. So almost a 50% reduction. And as Taka and I were preparing for the panel, we talked about what some of the reasons are, right? One thing we've seen is cloud computing has had a dramatic impact on capital efficiency in venture-backed companies. So things that used to be fixed costs now are variable costs. And when I became a VC, we would invest in data businesses, and they would spend $30 million on servers, on hard iron. Today, that's completely unnecessary. So we will use Amazon Web Services or one of the cloud computing providers, and we'll just dial up what we need and dial it back when we don't need it. It's a variable cost, and it's much more cost effective. Another finding from our research, this shows you the amount of capital going into venture-backed companies every year and coming out from exits. The last 4 years, the U.S. venture capital industry has been very cash flow positive. Last year, almost 2 to 1. So this is a tremendous number. Exactly. Another driver of discipline here is the fact that we're raising less money in the industry. So this is the amount of capital that U.S. venture capital firms raised each year. And in 2000, we had the biggest year in history. That had tremendously negative effects. So the low returns you saw in the earlier charts in 2004, for instance, were driven largely by this mistake, by way too much capital being raised and too much capital being thrown at companies, lack of discipline. So the last 10 years or so have been historical low levels of capital raising by the industry. Now, I would mention one point of caution, that so far in 2014, just halfway through the year, we've raised about $16.5 million. So we're seeing much larger levels of fundraising this year, which could augur problems. And we could be on pace for a 2007 type year, which was about $35 million, and hopefully it won't get much greater than that. This chart shows you the returns by industry sector. Maybe a little bit hard to read, but we showed this to our investors at our annual meeting, and we asked them, what's the pattern of returns? The answer is there is a pattern, that one sector or subsector can be up 1 year. Take consumer services, for instance, in 2004, and then it can be very bad in 2009. Dame desne, as they say. So again, our philosophy is we have to diversify across sectors. Here's a fun exercise. We looked at we looked at the returns of companies based on where they're headquartered. And the West Coast states are marked in green, East Coast in red. So for the benefit of most of you who are very familiar with the United States, but West Coast cities or venture centers, San Francisco, Palo Alto, San Jose, San Diego, Seattle, and so forth. East Coast, Boston, New York, Washington, Atlanta, right, and others. So who here thinks that over the last decade that the East Coast had higher returns?
Raise your hand.
Okay, one. Who thinks that the West Coast had higher returns? Okay, some more. Now the answer? You're both right. So amazing story of capital efficiency, that both the average return, the mean return, and the 90th percentile return, the winners, were almost exactly the same. And what this tells us is that capital is very efficient. It will flow to where the returns are. And you take Fred Wilson in the early 2000s from Union Square in New York, investing in digital media at the very early stage. There weren't many people doing what he was doing. He showed an incredible amount of vision in doing that. And now there are a lot of people that want to join Fred and the dollars are rushing. The two geographies got there in different ways. Whereas returns were virtually the same, the drivers were different. So on the West Coast, we saw higher exit values. And a lot of them were very high profile, right? Twitter, Zynga, Google, etc. On the East Coast, we saw actually a little more discipline. We saw lower valuations, and we saw more capital efficiency, less capital required to get to an venture is a hits-driven business. It's a relatively small percentage of the deals that generate the big outcomes. So less than 10% of the deals generate greater than 5x. However, there are a lot of absolute numbers of good outcomes. And actually, I heard one of the panelists mention how many companies there are in the US venture ecosystem. It's a very large number of startups. So what you see here is we define winner 5 different ways. And this was an analysis we collaborated on with 2 other well-known venture capitalists, Neeraj Agarwal at Battery Ventures and Glenn Solomon at GGV Capital. And they suggested this analysis, which we did off our data set. So it shows you winner defined as one VC received a 5x return, or one VC received a 10x return, at least one, maybe more in the company. One VC received a $50 million profit, at least, or one VC received a $100 million profit. And this shows you the absolute numbers over a decade. So divide these by 10 in your mind, and that's the number per year on average. Right? So about 82 deals do 5x. Now, in terms of year over year, it's a better story, and specifically in more recent years. So, say 2012, for instance, there are about 125 companies that generated 5x output. And these numbers have been increasing dramatically since 2008. One that I like to look at is this $50 million profit, right? So about 77 companies last year exited, generating a $55 million profit for one of the VCs or more. Looking at IT and other, which might include consumer, retail, financial services in the other category, and in healthcare, right? Both of those areas have significant numbers of winners. And in terms of the probability, healthcare actually has slightly higher. So we're seeing a lot of venture funds in the US going into e-health and what have you. Saeju will share some of those insights with us later, as he's on the cutting edge of that movement. One final slide, and one thing we looked at was returns in US venture matched against the public markets. And oftentimes people compare the wrong things when looking at venture. They look at the returns in private portfolios. How are VCs marking up their still private companies, which is not a reflective really of value creation. What we did here was we matched the exits against the public markets. So an apples to apples analysis, as we say in the US. And the story here is very, very good. So again, we assume that on a given exit, Fred Wilson on Twitter bought Twitter stock the same day he bought the S&P 500 total return analysis, and he sold the two on the same exact day, right? So this shows you for each exit year, what would the comparison of those two areas look like? Public markets versus the private company. In the last 2-3 years, dramatically better returns in US venture, which may explain why more LPs are putting capital in space.
Yeah. That means that they usually invest in US venture capital.
Yes. So again, just a brief introduction into the US venture capital industry. Taka, thank you for letting me do that. And overall, the story is very good, but we have to maintain the discipline that we've had over the last decade.
Thank you so much, Trevor. This is great. Frankly, even for me, I started the venture capital in San Francisco 2 years ago. I've been doing the startup in Japan, and as you know, that the Asia venture ecosystem is still small. The number of investment, the number of venture fund is still small. But looking at the history of the US, and then like the last slide, I'm saying like even with the public investment, venture capital performance is much nicer. So hope we should have a bigger venture industry in Asia as well. So we'd like to discuss more about venture investment, but also we have a great startup guy from the West Coast and East Coast. So from Masami, you just joined the Uber this month, right?
That's right.
So how is it? And then it would be great to share your story. How you joined Uber, and then your operation in Japan and Asia.
Sure. So as Tak just mentioned, I'm a relative newbie to this world. I joined literally a little over 2 weeks ago. Until last month, I lived in San Francisco, and I just moved back to Japan to join Uber. So that's where I met Miyata-san in San Francisco. So before I used to work at Sony, and I was mainly looking at M&A and investment type of deals, mainly out of the Bay Area, and engaging with a lot of startups and companies out there. So a little bit on Uber, as I'm sure you've heard of, especially the audience here. It is a technology company that offers a platform to seamlessly match drivers and riders. And it is now operating in over 140 cities around the world and over 40 countries around the world.
By the way, how many of you guys they used Uber before?
Ooh, wonderful. How many of you in Japan?
Not bad. Not bad.
I think it's a pretty skewed audience, but yeah, we just in Japan we just started our operations officially about 4 months ago. So it is a new service that we're offering, and as I mentioned, we're operating in all these different places, and we have the same app that works across the world. So that's one of our strengths, is the simplicity of that application. But at the same time, our business model and how we operate differs from city to city, country to country. So in Japan, we actually operate we're registered as a travel agency. So we don't own any cars, we don't own any drivers, we don't hire any drivers. We partner with the limousine hire companies in Japan. And so we basically match their drivers and their cars to the users of the Uber app. We are operating in Tokyo. And we're seeing actually very good demand in Tokyo. So when we took some data over the first few weeks post-launch, compared to the demand that we saw in places like London and Paris, we're actually seeing 2 to 3x the demand in Tokyo. So while Tokyo, as we all know, is a very, very efficient city with very good public transport, we are actually tapping into a new type of demand.
Yeah, but as well, in Tokyo, it's easy to get a taxi. In one way, it's really hard. Everybody struggle to get a taxi, but nowadays it's easy, right? So that also supplies that so many demand to hire the Uber. So how do you analyze why it's the high demand?
Yeah, I think it's actually a different type of demand that we're seeing. We're actually creating new demand. So I actually read an article recently that Uber, we shouldn't compare Uber just to, let's say, the taxi industry, because I think that the people that take Uber may have not used taxi before. It was maybe they have their own cars, or they used other types of public transportation. But now, because of the convenience, reliability, and the transparency that Uber offers through the platform, I believe that's one of the reasons why people are coming onto the platform.
Okay.
And actually, I just want to take this opportunity. So today is actually a very special day for me. First of all, because it's such an honor to be here and talking to a crowd like this in Fukuoka 2 weeks into my job. So thank you once again to Miyata-san for inviting me here.
Yeah, why don't you talk about your special project today?
So exactly. So I'd like to introduce my special project. I'm wearing a T-shirt here. So today, it just coincidentally, but we are running Uber ice cream in Tokyo for the first time. And this has become a tradition at Uber. And I think it really represents what Uber's all about. It's really about giving users a new choice. So basically, for those who are not familiar, if you open the Uber app today in Tokyo, below where you choose a type of car, there's sedan, there's van, and just today you'll see ice cream. So from the Uber application, you can actually go with a few taps, order ice cream, and have it delivered to your door. So it kind of shows what Uber's all about. We're a very fun company, and we're just kind of showing and I think utilizing the power of the technology that we power.
But also, I like that project as well. But I want to mention that Uber Rush, which is a beta project in New York. actually in Japan, like Bento, JP, and some other stuff, they started trying to do the delivery, new type of delivery, through mobile phone. It's trending in Japan. And they, we just, a little bit talk about that Uber Rush product in New York.
Sure. So Uber Rush is something that we've been running for a few months now in New York, and it's a mechanism basically for people to have goods delivered. So before we were building a grid of supply and demand riders and drivers, transporting people from point A to point B. Uber Rush, very simply put, is a platform that transports goods from point A to point B. As you mentioned, I think these services are up and coming. They're much more prevalent, I think, having lived in the U.S. than in Japan. And that's one of the reasons why I actually joined Uber and saw a lot of potential here. Is that coming back from the Bay Area, I mean, there are so many services there that I used that were much more on-demand and convenient, on-demand cashless that exist out there. And I come back here, and there's still a lot of cash transactions, a lot of paperwork. Back 20 years ago, so I spent a lot of time, living abroad, growing up, and every time I come back to Japan, I was so excited by how advanced this society was and how it operates. But now, this time around, I've been away for 7 years. Coming back, I kind of look at it and I say, I wish services like this existed. Including, some do and are coming, including Uber. But I just feel like it's really a great time for Japan to try out this new type of wave of on-demand services like Uber or Uber Rush or other services, and really become a part of people's lives here. And as we all know, having been living in New York and the Bay Area, it's become part of our lives there. And I just hope that in the not so distant future we'll see a similar trend in Japan, because I think it is really about giving people more choice. And people really, if they learn, if they experience the solution, I think they'll gravitate towards them, and that'll spur a new wave of hopefully Japanese services and startups, building their own solutions and services and exporting that to other parts of the world. That's something that I'd love to see in the coming years.
Yeah. Thank you, Masami. So Saeju. So would you talk more about your company Noom, healthcare mobile app in New York, and the we didn't. I mean Trevor didn't mention about seed crunch, but actually the US easy to raise a seed, but the many startups struggling to raise seed A, seed B, and then you successfully raise the seed A last year, right? So why don't you share your experience about raising money in the US?
So first of all, Noom is about we are building a wellness software platform for the weight loss right now. So we are making software. We set company 7 years ago. We did a lot of crappy prototypes. The first 2 years struggled a lot. It became very good. The lesson that we learned, we pivot to a mobile platform, and we built an Android iOS product, and it's been a great ride the past 5 years. So what we are building is a software for wellness, and we are making a coach, the virtual coaches, quite a lot of technology that we need to, not just tracking your exercise and food, we need to provide writing messages and coaching every day. So that's core technology what we have as a software company. The second question about the Series A crunch, right? So when I started the company, again, I raised capital 5 years ago from a lot of angel investors. And there was, nothing is easy for raising capital, but there was all about people and our mission, our vision, and investors, angel investors, really focus on about who is building the product and who is carrying the mission. After we successfully raised the capital from angel investors, we were making progress, and we launched the product, and we need more bigger capital, Series A, enter the Series A to build a faster, stronger team. And then we faced that because there are a lot of investors, like big investors. They came down to an easy level, like a lot of seed investment, but Series A, they became a little more cautious because there are so many early seed companies trying to get the funding relatively easier than 5 or 10 years ago. And now,
they are out of all those companies that are raising like next round, Series A, and they require a lot more original numbers, profit, business models, team, product, even bigger team like that. So what I did build relationships with our previous investors and newcoming investors from West Coast and East Coast like that, and we provide update how we're making progress and how much progress and the visual we kept our promise like that. And when we raised capital, it became like very natural that our investors, actually I called my investors partners. The partners came down and then it was a very natural conversation. I needed capital and they were right next to me. And that's how I closed the fund. But I know it's become, people say it's difficult, but to be honest, I think this is a symptom that the ecosystem is getting very healthy. What it means, to start a company, it doesn't cost that much as it used to cost a lot more money before. What it means, we just need a laptop, nice internet, and you can start a company these days. So start a company, new idle concept, build a new product, costs less. So there are more people who start companies. There are more coming in, and you don't need that much big capital at the beginning. So I think that creating not only the VC, there are also rich families or who is interested in this tech field, they constantly invest. So there are more investment channels created lately. So the way I view this next is like there are more people who go to college, higher education, and people complain about it's hard to find a job after they finish their higher education, the curriculum or the college. That's how I feel. So there are a lot of companies.
Yeah, well, I mean, you mentioned that you raised money from East Coast and West Coast. Like, generally speaking, like venture capital investing, like the company, there's like the 5 minute drive or something, right? But I mean, how do you see like it's like you mentioned that the East Coast and West Coast, and then do you invest in the East Coast as well?
Yes, our firm invests coast to coast, and we have investments in virtually all the major venture centers. Bay Area, about 60% of our investments, but also Southern California, including San Diego, LA. We're in Boston, New York, Atlanta with investments, Nashville, Tennessee, Austin, Texas. Very, very diverse portfolio. One thing I would add
do you travel a lot, like visiting the office?
So Correlation doesn't take any board seats. We typically invest with another new VC, someone that comes in at the same time that we do, who takes that board role. Okay. And oftentimes the management teams do not want another board member. So they'd like to have one great new VC leading that round, and they don't want 2 or 3. Okay. So we do not travel for the board meetings.
Okay. But in the how about the Saeju, like the New York, Palo Alto is more like Singapore and Tokyo, like 6 hours. So like, do you travel a lot to meet the people, like venture capital in Palo Alto?
Yes, I do. So from my seed investment in the Series A, the way I create the investment portfolio from my end, I purposely traveled the Asia, Europe, and in America, West Coast and East Coast, because this is every entrepreneur, you used to be entrepreneur and you're an entrepreneur too. Entrepreneur has different, like a strong belief and philosophy of how to run a company. This is my belief about investment. I build a company with great people, and I believe each great people who will achieve success at the market knows how the business is working. And our dream was to build the world, build an empire in the world, a big company, very big software launch company. So I traveled and I found the best investors from Europe, in Asia, and East Coast, West Coast. That's how I lined up investors. And this world is very small. When I'm in London, they know my investors from Asia and West Coast for sure. Almost they know each other. So I create momentum from investors. They like this business and they like this goal. Then they get together. My job, deliver what I promised. So yes, I do travel, and they are like you gave us like a presentation about what's the trend. They are the most sophisticated, smart people. What's going to be happening next year, and 2 years later, 5 years later. So my job is to learn from that of investors. That's why I call them my partners.
Yeah. One other story I want to share that you just joined the accelerator. Like a definition of the accelerator used to be like you have an idea with no money and no product, and then join the accelerator, and then like the people have the experience supporting the company to create a product, right? But Saeju, is Tuesday, recently joined the new accelerator. So could you share the story? Why your type of company decided to join the accelerator at this moment?
So yes, sir. So accelerator became very trend, and now it seems like there's new trends coming. So we are in the healthcare and wellness sector. So we relatively raised pretty good, the fund, but from real big healthcare sector, like a pharma company, hospital, and health insurance company involved, it's not that big. The problem, to really disrupt the healthcare system, I need a lot of help from existing players, the gray hair people, where the pharma company, hospital, and organization like from the government sector, healthcare sectors, they are like at our parent level, and they use different language. I use different language. So the problem is they are always looking for the innovation. Always say innovation. CEO, chairman, gray hairs, we need to innovate this, blah, blah, blah. Always say. And I shout as a young man, I want to disrupt this market with technology. We say the same thing. The problem is, it's not English, not Japanese, not Korean. It's about we use different terminology, different words. So it's really hard to get things done. So New York City is trying to create the best tech company must work with a healthcare expertise, hospital, pharma company, health insurance companies. So they put together, the CD is trying to you must work with tech company, you must work with old people, put together. In 6 months, deliver the outcome that we call pilot, clinical data. Imagine getting clinical data from our perspective, we are poor, we are a small company, we don't have many people. And these big companies, they're slow. But now the CD create this playground for us, and they force us to deliver in 6 months the outcome. This is fantastic, so we can expedite the progress. That's
Yeah, this is kind of really important trend. The Disney just started Disney Accelerator, supported by Texas. Actually, I'm visiting, the Disney Accelerator next week, which is great because Disney is a huge company, but the company, 11 company in the first batch, they have access to the, all the asset, the character, the story of Disney, which usually the staff doesn't have access, right? So actually they used to be just acceleration, they put the money, that's it. But now big companies started, they looking at the startup as a real opportunity to work with. So I had that in Japan, KDDI and 7-Eleven, big confidence chain, started providing data for the startup to work with. So that should be the good trend, only in US and the Asia. So yeah, thanks. So go back to Masami. The Uber. I remember that the Uber raised 1 point something billion with 17 billion valuation or something. So pretty much a big amount of money, right? So what is your operation in Japan? It must be huge.
So actually, yeah, just to recap, last month we raised 1.2 billion at a $17 billion valuation. So just so we're clear, I wasn't any part of this because unfortunately it was before my days.
The one thing I just checked the valuation of the Japanese company, the lines supposed to be going public, this year, supposed to be a 10 billion or something Joen, right? And the Rakuten is 1.8, almost the same as the newly developed startup in the US.
That's right. So it is a very big sum of money that we raised, and we're as a company, very excited that we were seeing demand from the user side and also onboarding a lot of drivers. So from the driver side, so as I mentioned earlier, we're about giving choice, and people are coming onto our systems. That was great. Now we're seeing that the investment community as a whole is actually seeing a lot of potential for Uber. So it's really helped us further accelerate our expansion. So I guess we're probably launching about 3 or 4 cities every week. So even internally, we're kind of losing track of how many cities we're in now. I believe we launched in Hong Kong yesterday officially, and it's just a very strong momentum coming right now. As for Japan, it's as mentioned earlier, we just launched our service in March, so it's a very small team. It's only a few of us, sitting in an office. managing both the supply side, which we say is the, the driver side, and getting cars on the road and making sure that they're operating smoothly. And the other side is demand creation, so letting people know that Uber's out there, we're operating now and now in Japan. So it is very, very, so it's a unique balance where we see very strong backing from our headquarters in San Francisco, our Asian HQ, and getting a lot of support there for a lot of the central functions. But we're the small team here is basically the experts of Japan. We're all Japanese, and so we understand the market and the restrictions that exist here as well. So they give us a lot of autonomy to build the business here. But when we need support, we get that from the central side. So.
Right. How about the UX? I mean, as a user in San Francisco, I always use like a UX. I like it. So I mean, it must be difficult to launch UX in Japan, but are you going to launch UX in Japan?
So personally, UberX was a product that I used in San Francisco. I think that's something that's really taken off over the last few years, and it's changed.
Yeah, maybe good to talk about what is the difference between Uber and UberX.
So Uber has, depending on the city, right? But like in a city like San Francisco that has different tiers. The highest end is Uber Black, so it's kind of what Uber is known for. So it's our high-end black service with limousine hire type of cars. And then we also have Uber Taxi, where we partner with traditional taxi drivers, and so they have the Uber app running, and they're driving the streets, and when they can't find a street hail and they get a request from Uber, they go pick them up. So that's the second tier. And the third tier is UberX. So this is the peer-to-peer P2P service that we have, where we're actually onboarding just regular people like ourselves with nice cars. Moderate to nice cars, and obviously there's a lot of screening process that happens to get them on board, but once they do come on board the system, they're able to just drive around and pick up customers upon request, just like another kind of service. So this is something that's been very, very efficient because the supply that we can provide to the market is so much higher. Because there's just a lot of us that want to take this, and it's actually creating a lot of jobs, like thousands of jobs, especially around the U.S. where UberX is really, really heating up. I think that the biggest concern that people hear when they hear the model that UberX is reliability and quality, because these aren't professionally trained drivers driving around. Obviously there's a very rigorous process to get them on board, but after that, what makes Uber pretty unique is that we have an evaluation system. So, I saw that many of you have taken rides, and you may have seen this, but after each ride, you have to rate the driver from a scale of 1 to 5. So if you have any issues, you flag them and say it was a 1-star or 2-star, and you comment, what was the reason? Did they take the wrong route? Did they arrive late? Were the manners bad? Things like that. So it allows us to automatically keep track of the quality that our drivers are providing to their customers. And if the rating is low, then we just say, driver ABC, sorry, your rating has fallen to below threshold, so we must put you off the system. So that's how you maintain a high level of quality, even with the P2P service.
Okay, got it. So as I want you to take some of the questions from audience, so that the last point I have is that Asian and US. So the Trevor is you spend several days in Tokyo to come to Fukuoka, right? So how do you see the opportunity in Asia? I mean it used to be like a US venture capital only invest in US. But how do you see difference in the future collaboration between the Asia and the US and the Western culture in terms of venture investment, venture ecosystem?
Sure. So I had the opportunity to live in Thailand as a child for 3 years. My father was a U.S. diplomat, and have really enjoyed the visit to Japan. I'm very optimistic about the growth of the entrepreneurial ecosystem here. I'll give you a perspective of the United States. For us, entrepreneurship is so critical in terms of job creation. So in a typical year, average year, 3 million net new jobs are created by startups in year 1 of their existence. That was derived from a study that the Kauffman Foundation did in the United States. Big business, almost no gain. They hire and fire, so net zero. Business or government, declining year over year. So virtually all new jobs come from entrepreneurship. And if I look at Japan, Japan has higher employment rate. We have a higher unemployment rate in the United States currently. But I'm very optimistic about the value of entrepreneurship in terms of the growth of the economy. And so we currently are only investing in U.S. headquartered companies. We would like to invest in Asia in a future fund. We would have to build a data set of Asian venture capital outcomes. So we would not be foolish enough to come here with our algorithm and assume that the factors would be the same. So we would have to put the rigor behind it. I would say that we do have 3 members of our team in India, right, currently. So we have part of our predictive analytics infrastructure. So optimistic about the future in Asia and the energy of the entrepreneurial sector here. But we're going to wait for a future fund when we're prepared.
Okay, sounds good. Saeju, I mean, I think that some of the audience, the entrepreneur in Asia, like I want to go to US to raise money, but you did, you originally did the business in Korea, but you moved to New York and started a company. So would you share experience, how different, like from Korea and New York, and then any message to the entrepreneur in Asia?
I came to New York because first business I did in Korea, I felt like I made a fast growth in my business. So, but I felt like the market was limited. That's why I came to New York. I decided to come to New York as like New York City is the mecca for international. That's why I came. I had to hustle a lot because I did not know any person. So I tried to meet people a lot, and I tried to build a new network. And that was difficult, not fun, because I have to keep smiling and try to meet people and then share my ideas. But that period gave me the chance that I could learn about how to hustle with people. Started, I think, I'm still making progress, but it's about speed, it's about persistence, I think. What you believe, what you envision is happening in your head, the concept, and you deliver that. And Asian people are very good, nimble, ninja. And also persistent, stick with a goal and get things done, try hard. So I think that working ethics is sums up great. And it's a matter of especially Japan market is big enough, so they already beat for domestic market, I guess. But there are great services for sure. Great services. And if this great service, sharp business models, product, land into America and from America to go to Europe, I see it will happen and it's happening right now. And another thing is there's a lot of great the talent pool from here. And once we get connected to people who is actually leading the industry, there's a lot of demand from Asia and both sides. So I actually am very lucky that I can have both sides right now. And I'm always looking for new talent and industry leaders' help. So I became a bridge. So I strongly encourage you, get out. Especially if you have good ideas, team, get out, get the fund, move forward.
Sounds great. Yeah, great message. So we still have 3 more minutes. So I'll take 1 or 2 questions from our audience. So anybody has a question to the venture capital at the house?
Mike?
Yeah.
I can speak up if that works. In regards to the analytics and the data, you had mentioned the exits from the West Coast compared to the East Coast are relatively pretty stable, pretty capital efficient. Is that from the VC's perspective? And what about the founder's perspective? Especially you mentioned on the East Coast, the pre-money valuations were lower, but the actual exits were relatively the same, right? So is that something should founders, I'm not saying looking to go make a bunch of money, go to the West Coast, or what does that actually mean for founders?
Yeah, so the question was, in terms of East Coast versus West Coast venture center attractiveness, should the founders locate their companies in the East Coast versus the West Coast, and what were the return differences to founders of one versus the other? So we have analyzed the number of winners in U.S. venture from the perspective of founders. And actually, that data would indicate that going into entrepreneurship early in your career is actually a very good thing. Now, I don't have the data in terms of how it breaks down by East versus West, but I was surprised at what the probability of having a good outcome as an entrepreneur was. It was actually surprisingly high. And in Japan now, we're seeing people go directly into entrepreneurship right out of university. Someone like Murakami's son at LiveSense, which is a great example, a very exciting company in that regard. But getting back to the East versus West, I guess I would advise founders a couple things. Don't pick up everything and go to San Francisco because it's trendy. And you do see startups do that. There's a balance. And part of the balance is where is your ecosystem that you can leverage, right? As Saeju was mentioning, to greatest effect. If you have a network of co-founders in maybe a university town where you're located, in Pittsburgh, Pennsylvania, Carnegie Mellon, or in Cambridge, Mass. at Harvard, don't leave them behind just to come to the West Coast. We do see people coming out, as Tak had mentioned, because some VCs have a reservation to fund outside of their immediate geography. The data would not bear that out as a strategy. So, in terms of deals that are far away from the lead investor, actually on a univariate basis, they tend to outperform, right? So you don't need to have the companies close to you to do well as a VC. So yeah, balance, right? Can you get capital in your local market versus where is your ecosystem? And one final point on the capital. There's a trend in US venture of angel financing through sites like Angel List, which have completely changed the game and have disaggregated access to capital from where you are located, right? So now through Angel List, for instance, I would encourage you to look at it at angel.co. You can actually access angels all over the world that have expertise in your area of focus. So there's greater probability today that you can attract money to Pittsburgh, I believe, than you could previously using things like Angel List.
Thanks, Bob. So it's time now. So yeah, thanks so much. Yeah, we had a great guest from the US. So yeah, please make the thanks to the guest from the US. Thanks so much.